All right, let's get right into it. We're talking about a story that, it starts on Wall Street, but it really ends right there in your kitchen cabinet. PepsiCo. We're talking the giant behind Doritos, Gatorade, Cheetos. They're about to make some huge changes, and it could actually mean your favorite snack is on the chopping block. Let's figure out why.
You know this feeling, right? You walk into the store, you're heading for that one specific flavor of chips you love or that exact size of sports drink, and poof, it's just gone. Well, turns out it's not always random. A lot of the time, it's the end result of a very deliberate, really high-stakes decision made in a boardroom.
And here it is. This is the number at the heart of the story. PepsiCo has announced it's cutting almost 20% of its products here in the U.S. by early 2026. Now, that's a huge deal. But hold on, it doesn't mean Doritos are just vanishing. To get what's really being cut, we need to talk about something called an SKU.
So what the heck is an SKU? An SKU, or stock keeping unit, it isn't the whole brand like Doritos. No, it's a super specific version. Think Cool Ranch Doritos in the party size bag, or maybe the 12-ounce bottle of G0 Glacier Cherry. So PepsiCo isn't ditching Doritos, but they are getting rid of thousands of these specific little variations to, simplify things. And that's the real issue, isn't it? What a company calls simplification, you might call getting rid of my favorite thing.
So why is all this happening right now? Well, the reason for this whole shakeup, it isn't some new CEO or a big shift in what we all like to eat. Nope, it's a really powerful force from the outside, an activist investor. And this is something we're seeing more and more these days.
And when I say powerful, I mean really powerful. This whole story kicks off with a massive $4 billion investment in PepsiCo. An investment that big doesn't just get you a bunch of stock, it buys you a very loud voice and basically a seat at the table to demand some serious changes.
The goal of an activist investor is pretty simple, actually. Buy up enough of a company so you can force management to do things you think will make more money and drive up the stock price. These folks are not passive shareholders just along for the ride. They are there specifically to shake things up. And a lot of times that means shareholder profits come before things like, say, having 50 different flavors of Gatorade on the shelf.
And the firm that's making this push? It's called Elliott Investment Management. They're a huge name in this world. And when they announced their $4 billion stake back in September, it was a massive signal to PepsiCo that, well, business as usual was officially over.
So, what was Elliott's problem with PepsiCo anyway? I mean, you don't just throw billions of dollars at a company without a very clear plan. They showed up with a full-blown critique of how the company was doing and a pretty clear list of demands. Elliott basically laid out their case in a letter. They said PepsiCo was underperforming, that its stock was trading at a valuation near a 10-year low. And maybe the biggest jab of all, its sales were falling behind its arch-rival, Coca-Cola. To them, the company was just bloated and inefficient. It was spending way too much money making all these niche products instead of just focusing on its blockbusters.
Now, this is really interesting. Elliott pointed out this one key difference in strategy. Unlike Coca-Cola, which has pretty much sold off or outsourced its bottling operations, which are super expensive to run, PepsiCo still owns and operates a lot of its own. Elliott saw this as a huge, costly weakness. Owning all that stuff ties up a ton of cash and makes the company way less nimble than a competitor like Coke.
So their demands were crystal clear. They told PepsiCo to follow Coke's lead on bottling, cut way back on all those unnecessary drink and snack variations, which of course is someone's absolute favorite, slash costs in the food division, and just sell off any parts of the business that weren't pulling their weight.
Okay, so facing all this pressure, PepsiCo had a choice to make. And instead of fighting, they decided to listen. They actually worked with Elliott to come up with a whole new playbook designed to fix all these concerns. So let's break down exactly what they're going to do.
All right, here's PepsiCo's countermove, their four-part plan. First, that 20% SKU cut we talked about. That's all about efficiency. Second, they're going to offer more affordable prices to try and get sales up. Third, some pretty tough cost-cutting is coming. They've already closed 3 plants this year. And fourth, they're going to focus their new ideas on products that lots of people want. Things with more protein or no artificial colors, instead of spreading themselves so thin. The whole point of all this is to turn PepsiCo into a more streamlined, more efficient, and, of course, more profitable company. But what do the numbers say? What are they actually aiming for with this new strategy?
So the company is now forecasting that its sales are going to grow somewhere between 2 and 4% for 2026. Now, I know that might not sound like a huge number, but for a company of this size, that's a pretty big deal. And they think they'll hit the higher end of that later in the year. And here's where it really hits the bottom line. By cutting all these costs and just running a tighter ship, PepsiCo expects its profit margins to grow by at least 1 percentage point over the next 3 years. That's a direct result of becoming a leaner operation. And it looks like the activist investor is happy with the plan. Mark Steinberg, who's a partner at Elliott, he actually came out and praised PepsiCo for their collaborative engagement and the urgency they've shown. So that's a pretty clear signal that the two sides are working together on this, not fighting each other.
And you can hear that same confidence from PepsiCo's own leadership. The CEO, Ramon Laguarta, said he believes these plans will deliver across the board faster growth, record savings, and better profit margins. So everybody seems to be on the same page about the path forward.
Which leaves us with this question, right? From a pure business standpoint, this could be a brilliant move, creating a much more profitable and competitive PepsiCo. But for us, the people actually buying the snacks, does it just mean that the next time you go shopping, that one weird specific flavor of chips you secretly loved might be gone for good? It's a classic Wall Street story that has a real-world price. A stronger company, but maybe a slightly less interesting snack aisle. And that's the trade-off at the very heart of this whole shakeup.